Okay, in this video we're going to talk about receivables and the issue with not collecting all our receivables. Let's start with the assumption that this is our first year of business, so there's no beginning balances, there's no beginning receivables. What makes accounts receivable go up? Well, when you make a sale on account, you're going to end up recording the sales and the receivables. So in other words, you debit receivables and credit sales. What will happen with these receivables is they will get collected, and when they get collected, you get the cash and you'll credit receivables. So assume that's what went on during the first year of business. Now, at the end of the accounting period, we have 10,000. Well, management or any company knows pretty certainly that they're not going to collect all their receivables. So knowing that, we are in essence overstating our assets and overstating net income, because you're basically knowing that not all of these will be collected, meaning not all of these sales were good sales. So what management needs to do in accordance with the rules is that they need to reduce their assets and reduce their shareholders' equity for the amount they think they're not going to collect. Now I emphasize think, because they don't know specifically who's not going to pay. But that doesn't mean you can't estimate what you think you won't collect. So what ends up happening is that we're going to set up an allowance account, and we're going to put a dollar value in here. And we're going to put it here instead of reducing accounts receivable, because you've got to understand that each of these receivables has a customer's name with it. So you can't credit this account unless you have a name. So in other words, unless I know specifically who is not going to pay, I can't reduce my receivables. So instead I'm going to reduce this allowance account. And you can think of this allowance account as a negative receivable waiting for a name. So let's say let's assume that management thinks that 1,000 of their receivables will not be collectible. So in other words, they analyze their receivables and they say, we think this amount is what our assets need to be reduced by. So the other side to that, instead of reducing sales, we're going to set up another account called uncollectible accounts expense. And that expense is basically going to reduce net income. So it's got basically the same effect as if we had decreased sales. All right, if you look at it, think of this now as we have this bucket that we have just filled up with $1,000 in it. That effect on our financial statements is to reduce our accounts receivable down to 9,000. So if you look at our financial statements for year one, our sales will be 100, but they'll be our net income will be reduced by the amount we think we're not going to collect. But more importantly, our balance sheet's going to reflect what we think we're going to collect. In other words, the $9,000 is the amount that will show up on the balance sheet. It'll say accounts receivable net of 1,000 for $9,000. Now what we're going to see in the next video is that this is basically already hurt our financial position. In other words, filling this bucket reduced shareholders' equity and reduced our assets. So later, when we actually find out who is specifically not going to pay, we're not going to have to expense them again. In other words, we've already allowed for them to go bad. We'll look at that next.